Hello, it's Richard Bowser from Property Investor News. I'm here with John Corey in the second of a series of interviews that we're doing on specific topics relating to property investment. John has been writing for Property Investor News now for about 9 years, so I was interested to get these latest thoughts on the property market. John, good evening.
Good evening.
John, in the last few months, obviously, we've had a sort of generational event in respect of the Brexit referendum result. I know you've got some thoughts on this in respect of how how a landlord should approach it. But what I'm hearing and what I've been seeing, which is obviously reflected in the wider media, an awful lot of coverage obviously in the last sort of 6 to 8 weeks after the vote. Obviously it was a really quite a shock, I think, particularly to many people in London and in the financial sector. What we're seeing in the media, the forums, etc., has been a great deal of fear, uncertainty and doubt. So do you think it's justifiable?
Justifiable, no. In the absolute. Justifiable in the whenever there's fear or uncertainty or we've never been here before, that certainly causes people to pause, that causes people to rethink, that causes people to wonder what they should do.
Yes.
So some of that's natural. Now let me try to put a couple things in perspective. So the UK has been around a long time, right? London has been the biggest city in Europe about as long as the US has existed as a country. 1976, the UK was the first country in Europe to have to go to the IMF for a bailout because it went bankrupt.
Indeed, I remember
technicality,
it.
but
Yeah.
whatever. And yet the London market is healthy, okay?
Yes.
I think in the short term, the traders, the people who are doing things that are going to happen in weeks or months are going to have more trouble. They'll also have more opportunity because of the volatility. There'll be some low price stuff and some high price stuff that'll be causing turbulence. The person who's holding for 10 or 15 years, highly unlikely it's going to be more than a blip. You'll see it as maybe a long-term trend, and whether that's a trend up because the economy responded well or a trend down, don't know. But if you keep your place fully occupied and you pay down your debt over time and you retire with a big portfolio that's free and clear, does it really matter?
No, absolutely, John. I think I remember you saying to me many years ago, a US contact of yours talking about investing in low value areas. And I think I remember this well, and I've mentioned this on a number of occasions to people. Does it really matter if you're investing on a 30-year time frame and you're getting, say, a 10% yield? Does it really matter if at the end of the 30-year time frame, providing you kept the property in good condition, that it's had an ongoing series of tenants with few voids, etc., etc.? Does it really matter if at the end of that period, that property, say you bought it for $100,000 in the beginning, it's actually only worth 50 at the end if you've got 4 or 5 times its value in mortgage, in tenants' income on rents in that period?
Yeah, if you're investing for the cash flow, then the value of the machinery at the end doesn't matter as much. And if you're investing for appreciation long term, well, that's tied to the inflation rate mostly.
Indeed.
So the 30-year inflation rate's probably going to still be a big number, relatively speaking. So as long as sterling keeps going down in value, property assets will go up in value over time.
That's an interesting one to think about.